Yeah, you have time working against you in the short-term options. They're cheap, but you have your benefits, but then time is really not your friend at all. And unless it's really fast, then yeah, you can go your direction, but you still don't make any money.
Hey, welcome to Hedge Heads, where we discuss the commodity markets, hedging, and anything related to trading futures. Remember, the risk of loss in trading commodity interests can be substantial. These are opinions only and not trading advice. Well, no one knows where the market's going. We're not afraid to share some ideas. I'm Ryan Tunkseth. He's John Prishman. Well, John, we have a beautiful spring day here, May Day in Minnesota, here in west central Minnesota. It's been quite a beautiful week for the last week, probably the best fishing opener in the last few years, maybe not actually for fishing, but weather-wise for sure. But we are seeing weather delays across the country. What are you hearing from people you talk to?
Yeah, the East, Illinois, they were going, and now they're not. And of course, it depends on the region, so it's real slow there. The Ohio Valley in general. And then south of that, so you're seeing the weather delays, which is kind of astonishing considering that a lot of people could have planted and they chose not to, and they were going to wait for a little bit of rain, and that's actually cost them a lot of time now. So they're going to be scrambling. They'll get it all in. The numbers fell behind this week, so they put a bid under the corn market. I think until you start really seeing it pick up, that that bid will probably be there. But then corn's tied to wheat now, and wheat had a bad day, so corn got drugged down, and then you could see some selling in the front. But overall, very dry in the west. But even here, there was I talked to a guy in South Dakota. He had 8 inches of rain, so not necessarily even going every spot around here, but more or less every direction now. You're going to see, in the west, you're going to see stuff moving.
So from a delay side, and I guess for you, it's from talking to the people you talk to, but how much, we're not really in a delay until when? Or are we pushing the area where we're actually behind and this could affect yields? This could affect what we're going to see?
It's what they'll talk about it, and they'll say it's not the optimal windows and use a lot of words like that. And, what is the optimal window anymore? It's changed a lot for beans and corn. There's a lot of early planted beans now that are doing better than, historically everybody had planted late and they thought that was the best window, but they're discovering these early stuff is actually better. So it's just more of something to trade short term than really any impact right now. They didn't seem too worried, the guys I talked to, but I meant they would like a better forecast, but no genuine worries. And I don't think the market genuinely worries, but if it got a lot wetter in the forecast, that might be an issue for a week or two.
I did see somebody comment on Twitter that they were seeing a lot of producers selling into these rallies we've had over the last week or so.
Showed up in corn today. July was 3 cents weaker than December, so that's what when I talk about spreads, that's the important stuff to pick up on. It does look like indeed that did happen, where corn's moving into the pipeline. One day does not make a trend, but it's worth noting when you put 3 cents a carry in the market one day, that's pretty significant up front.
Sure. And, well, maybe we should go into just a little bit. I don't know if you can keep it short, but when you talk about looking at those spreads, watching that get in, what exactly are you watching? What do you kind of watch
it's a good
for?
Gauge on demand in the pipeline. That's so the argument is they don't get paid enough corn for the demand. Domestic demand is wonderful, but once those commercial channels fill up, then it's hard to get a good price. When they're empty, it's very easy, which people have experienced for the last few years. Not this year, but, so that's what you need to watch. So when you have good exports or good demand out front, it cleans out those channels, and they need to bid up the front to get it out of your hands that you're sitting on in storage. So we haven't been in an inverted market, and we're not, but they have been taking carry out of the market. So that's good. Some of it was short covering, so it's kind of, they skew that for a while. But when you see days like today, those jump out at you as not particularly strong. But you can't say that it won't change tomorrow again. You've been seeing these flip-flop a lot, and if anything, it's misled a guy more than helped him. But I think as this short covering winds down, that's what you want to watch. See if we actually sell any of this stuff after a rally.
That makes sense when we're kind of looking at those, and those are ways you can look at related markets, right, or look at other parts of a market to kind of gauge where the market may be going.
Yeah, for sure, especially tighter markets, no deliveries, inversions, you can be a little more confident buying these big carry markets are tougher because they're great till one day they just go right back to what they were trading, bearishness. So, but it's nice to see them take out some of the carry. It was extreme this year. And these funds were extreme on the short side. And that's another big thing is that they covered a lot of their shorts. And, beans is probably getting close to zero to almost a net neutral position, which that's very fast how they covered all that, almost all last week. And it looked like it continued on Monday at least. Today did not look like it. And without that short covering after a rally, now you got to find new buyers up here. And that's where the test of the market's going to be. Can you attract new buyers? Guys I'm talking on the phone seem interested in corn. I mean, it's been actually really quiet, I think, because of plantings. But I think corn is the one that guys are more interested than beans, but even that, they're pretty hesitant. Beans just don't have a lot of good news, and this weather's not bullish beans because you can plant beans later. So, corn is the one that if guys are calling, it's usually that, and a lot of calls on wheat. The problem with wheat is it's just so hard to tell. It's rallied a lot, and it's wheat. It's like it could give out at any time and not care about the stories it really cared about, or it could continue, and that's just pretty typical of the wheat market.
Yeah, what's the saying? Trade wheat, sleep in the street?
Yeah, among many other wheat sayings.
There's plenty of them. Well, along those lines, sleeping in the street, I guess, go that way. I did get a few questions when I talked about trading short-term options last week as I bring up sleep in the street because my account sometimes makes me think I might have to. But, I just wanted to talk briefly about what I look at and not specific trades. But for instance, currently I have been watching the soybean market. It had the big run up last week, which was opportunity to have bought calls. It moved significantly over a number of days. Now you could buy a call if you think it's going to continue. When I talk about short-term options, I look at the most current upfront contract, which in this case, if we're talking soybeans, is the June options, which are traded on the July contract. And I'm looking for opportunities just to hold for 2 days, 3 days, sometimes just for the next day. And those are ways that you can buy the option, what your downside is, right? So whether you're buying a call or a put, if you don't get rid of that one, you're going to lose the max you paid. So $200, 4 cents for an option, say, or 10 cents is $500. You know what your max loss is on that, but you also have unlimited upside either way, whether you're going what's unlimited upside? Usually it's going the other way, right?
Yeah.
But, there's certainly opportunities, especially as we head into this time of year, for short-term options to work really well. There's also the fact that most options do expire worthless. So we're making a position play similar to trading the front month contract short term, but you have a bottom in place. Now, that being said, I need to point out that especially when I look at just because the July soybeans move up 10% does not mean your call is going to make any money, because there's a whole lot of other factors in. I don't think we're doing this as an options episode where we could get into that, but just because you're right in the direction by buying a call and soybeans go up, or you buy a put and soybeans go down, if it's not a significant move, you could very well still lose money in your options.
Yeah,
so,
you have time working against you in the short-term options. They're cheap, but you have your benefits, but then time is really not your friend at all. And unless it's really fast, then yeah, you can go your direction, but you still don't make any money.
Yep. Well, and I think we're talking from a speculation side purely. I mean, there's maybe some short-term hedging opportunities
For
here and
USDA
there,
reports, they work. Short-term stuff works really well, and the June report coming up is one of those that is historically a very big market mover. So it does fit those types of USDA reports very well.
Sure. And there's a lot of other, I brought up soybeans as an example, but actually like the S&P 500, there's more options traded than the actual contract itself.
Yeah.
So the derivatives are traded significantly more than the actual contract itself, and those play in. And of course, then there's others like, say, lean hogs in May, where there's like no options traded and very little trade on the contract itself too.
Yeah, so that's gotten very popular in stocks. People realize how much leverage you can get with these options. So if you're right in the short term, I mean, it provides a lot of leverage for very little money and very little risk, because you only risk what you pay for the option. So that's the attraction to that. But then you have to get ready for a lot of misses too, because you got such a small window. They're tougher. They're definitely tougher to make money at. But when you do tend to make money, it tends to be fairly quick and fairly good, just by the nature of the length of that you're going to have them on. But great, they're great for USDA reports that you expect a lot of volatility. Maybe not. You don't know the direction. You can buy. I think we talked about straddles. It's just they're great for that. A lot of times when you roll into a USDA report, there's basically the front option has about 14 days. That's pretty common. So we haven't had those kinds of reports for a while, but this June report is going to be one that probably has a lot of surprises in it, and it historically moves the market a great deal. Great for that. But again, you kind of know you get the leverage in the market, and you get a chance. I myself like longer term options. I like paying for a lot of time. You have this huge window to be right. So just you got to know the tools and what kind of markets you're dealing with. I know you prefer the short term, and I will too, but I'm more of a longer term guy, because it's got such you front more money, but it's more forgiving, a lot more forgiving.
Well, and I can say that I have a position in November being options.
Yeah.
And despite all the movement over the last 2 weeks, it's moved about half a cent, maybe. Yeah. And so even though it's gone against me, probably it's been almost $1, right, over the last 10 days.
Yeah, you've seen the market move. The implied volatility in these options still has not really picked up. Even if it does, it tends to drop the next day. So you're just not seeing that moves in options yet. When more fear and more volatility under the market, then you'll see those premiums jump. But yeah, it's been very, very quiet so far. The implied volatility guys are right on.
Yeah, I'll point out another way that I think short-term options can be used. You and I have talked about this before, but you can sell those short-term options against your position. Say you're holding a long a covered call, and be able to sell that. If it gets there, obviously you're closed out of your position.
Yep.
If it doesn't, you're making the money for that. Now, there's a whole lot of considerations. Where is implied volatility? Why are you selling this? What do you expect it to do? What is the time frame? But if you own something, you can sell that call against it. You want to talk more about that?
Yeah, it's been a popular strategy in the past, but this year the implied volatility has been so horrible, it's not a good deal. So if you're storing corn and you would sell it at this certain price, why not sell the call? If it doesn't make it there, you get to collect the premium in addition to you're storing your corn. And then if it does make it there, those are going to be planned sales anyway. Or if you're a feed mill, you'd be the other way. You're going to constantly buy corn. So if you would buy it at $4.25, why not sell a $4.25 put? That will get you long corn if it goes below $4.25 in that time frame. So savvy guys will use this, or if their operation, can have these extra, I would say, risks. That's a popular strategy. It has not been this year because it's been a terrible deal. Like you just cannot have that risk for so little in return. There's not enough to really look like. So let's just say at 5,000 bushels, you're selling a lot of time for 6 cents, not that far away from the money. Just a horrible combination. And most guys that have thought about it have, after you tell them the premium, they're not that interested. So it's been kind of a lost market here. Very few calls sold this year compared to other years, for sure.
Yeah. And you're talking, it's not a good deal right now. It's because of the implied volatility, right?
Yeah, very low. So if you're an option seller, you want to see a higher implied volatility. Obviously, not necessarily in a more dangerous market, just what you would normally get, you're getting not quite half, a little more than half what you would normally get for this, and it's just going into a time period where implied volatility jumps, or the price, just think of it as the price moves a lot more. Just not a very good combination, not yet, anyways.
Yeah, it'd be something to look at as we see maybe prices move more, or see, like you talked about, this report coming up.
Yep.
Could make the market move a lot.
Yep, and then last year it was the weather. It went from very low like it was this year, but not this year's worse, and then it jumped very, very quickly on that hot and dry, and there was some very good options sold, very good calls sold last summer. Very brief window, very few people, but the ones that were, the option value drained right after that peak at 640. I mean, it was just straight down, and all that premium drained out of there very quick. Unfortunately, just such a narrow window last year. This year looks like it's going to provide more opportunity if we could get those values up. It's still kind of that doggy value, though, that nobody's interested in selling. Now, if you're an option buyer, this is your market. This is, if you're a put buyer, you're a call buyer, these are very cheap relative to history. The market's saying it's not going to move much, and most likely that it is one direction or the other.
Yeah, and that's something we've talked about here frequently, is the implied volatility means, are you buying or are you selling? You can cover either way, right? I mean, you can hedge your crop by buying or by selling options.
Yeah, I meant you're never a true hedge if you're selling a call, because you don't know if it's going to be in the money and exercised. So there's a lot of, some banks frown upon that because it's not a true hedge, but you actually could have that hedge. So it gets to be that gray area. It's a little more of an advanced strategy, but it's, again, frowned upon for certain banks for sure. Certain big banks, they just don't like that it isn't. They like the idea of you hedging. They just don't like this half, maybe, hedge, because if you only get 20 cents for an option and then corn, you never do get hedged, and corn drops 80 cents, that's not a real hedge. You're missing on 60 cents of that, which can be a big deal in corn, especially when the margins are this thin.
That makes a lot of sense. I just saw some news come across the line here, so see what your thought is here, but President Biden just tweeted out, I just imposed a series of tariffs on goods made in China. 25% on steel and aluminum, 50% on semiconductors, 100% on EVs, and 50% on solar panels. Are we heading back into a trade war, John?
Yeah, it's going to be, what are they going to do now back? And this is how it didn't begin like this under Trump. He was a little more, this is what's going to happen, and a lot more aggressive. But I would guess that it made everything nervous today. Yeah, I mean, it was out in the morning. A lot on the soybean oil, which was confusing about what's going on there. That was down the most. But I would guess this is not going to be positive for the price. And again, these are the things we talk about. Like, you can't predict that was going to happen. There's been rumblings, and then all of a sudden, out of the blue, it happens. And is it going to intensify? What's China going to do back? It'll affect the markets, and that's why I like to use options, just for this stuff. You're gonna run into this exceedingly unpredictable tariff stuff that we got going on. And last time they thought that there was going to be a lot of tariffs, and the market went up actually for the next 3 months, and then one day it cared and it was all over, and it was down quite significantly in 2019.
I'm not sure any producers want to go back to 2019, but
no, there was a lot of reasons that was not a fun year. 19 into 20 was one of the worst, but it's fresh in everybody's mind, and there's no doubt that it's going to make longs nervous. The good news is the funds aren't long, so they're not going to throw it away. But still, I don't think it's helpful for the markets at all today.
Yeah. Any other thoughts you want to share today?
No, it's a volatile time of year where things change very quick, and you need to make adjustments really quick. So just get ready for that. I mean, we're gonna either have a wetter or a better forecast, and then rain is bullish now for corn, but then it won't be too long before that's bearish. So very busy for guys in the field time of year, and then very busy for marketing. Not a good combination, but try to pay attention. It's going to be very important this year, especially for a market like soybeans, who don't have the very good numbers. They have really pumped up demand, and we're not seeing that. So the carryovers could be bigger than what we know right now, and it's just a market that just doesn't have a lot of good news. But we still have these opportunities, and it looks like there's going to be a lot more profitable marketing opportunities. And that's what we're going to be concentrating on here. But the phones are really quiet. Obviously, guys are very busy in the fields, and it gets to be that time of year. But I can't stress how important it is to be coming up with your marketing plan for this time of year.
So that reminds me of a question I have for you. We haven't talked about this, but this tends to be a volatile time of year, especially the next 6 weeks, and volatility across the board seems to be fairly low. What does that give you a sign of anything, a feel of anything? Are you looking at opportunities from that?
Yeah, I'm on the long side of puts and calls, but it's unusual. Yeah, you don't see this look very often. Guys don't like to buy longer term puts this time of year because all the time they're usually really expensive, and there goes their profits. This year it's not really like that. They're so inexpensive for a very long time, for a big amount of time. So I guess we're concentrating on just getting involved in that nice and slowly as the market moves up. But it's very odd the way they're pricing this stuff. And then, of course, someone's going to be proven right or wrong very quickly, either the calls or the puts guys. And you're going to see how underpriced this actually was. But we're not at a time of year where we're going to see that move yet, I don't think. Probably back and forth, leaning slightly bullish just because that's the way it's been for the last couple of weeks. But again, this is where the opportunities lie a lot of years, where it's quiet and then it gets volatile, and that we're headed to that for sure, especially by the end of June and that June report.
So when you talk long-term options for you, right, like corn, you're talking December and March, and soybeans November, or what's long-term do you look at?
I had been looking at December corn, but when you look at the March corn, it's a much better deal, which, again, exceedingly rare that you would see this. There's carry in the market. They're not quite the same price. It's more expensive in March, but still, the March offers the better deal. A lot of guys are interested in January instead of November beans because that's the third week in October for the beans, which is historically a bottom. You don't want to be short going into the first October in beans. That's seasonal. But with the trade war and Trump possibly getting reelected, the guys are asking about January puts, which would include the election. So yeah, I'm a fan of March right now and January, but that does change very quick too.
Yeah, I think something important to point out is that when you say a January put, that actually expires sometime at the end of December, probably right around Christmas.
Grains are always the third Friday the month before. So if you're January or December, it's actually expiration in the third week in December.
Yeah, I think a lot of people forget that. They want January, or they talk November, and you're saying, I want this November. Well, that expires the third Friday of October, so it's actually before the election. Right?
Yeah, and then you get a market like feeder cattle, which it's going to be usually the end of the month that you're buying. So if you buy in March, it's almost all the way through March. So you just have to know your markets and your expiration dates. And if you don't know, you can just simply ask us.
Yeah, I think that's interesting when I do trade some energy options too. Like natural gas expires the exact same day as the natural gas contract, and crude oil, the options expire like a month before the contract. I think it's actually 2 weeks.
Know your markets, and it's just there's no cheat sheet. You just got to kind of through experience figure it out. I'm sure you can get an option expiration calendar, but it's just knowing your markets, and grains don't change. It's always the third Friday or very close to the third Friday of the month before.
Excellent. Well, John, tell us how to get a hold of you, or let me mention the email address. I guess I always forget to do that, but Any questions or comments? You want to make fun of my short-term option positions or make some recommendations to me? You can email us at hedgeheadspod@gmail.com. Our website is thehedgeheads.com. John, you want to share some contact info?
Yeah, sure. You can get a hold of me at 218-731-1578 and just ask what guys are doing, what's popular. Just any ideas on if it's a good idea to protect prices up here. Just give me a call, and we would go over it.
Thanks, John.
Thanks. I had been looking at December corn, but when you look at the March corn, it's a much better deal, which, again, exceedingly rare that you would see this. There's carry in the market. They're not quite the same price. It's more expensive in March. But still, the March offers the better deal. A lot of guys are interested in January instead of November beans.